Hello, everybody. This is Mark Mishkin of Hyperpyron International Partners and the Belkin Report. I have Michael Belkin, who's going to give us a brief overview and update. We will be doing these calls periodically in the future for clients and prospective clients. And if you are interested in the work, it is available at www.hyperpyron.com. Michael?
Okay, hi everybody. Thanks for listening in. I'm going to start with the fundamental picture about what's going on. Tariffs, that's the big story, right? April, we had the president pull out all these super high tariffs, crashed the market. He panicked. He cut, he pulled them back, and then he's kind of eased them back in at a lower level. And the market has bounced enormously over that time. And basically, I think psychology is really extremely over bullish for no reason. It's been primed. So, retail keeps buying. If you look at the flows, institutional investors have been selling, not massively, but there's been outflows for the most part from institutional. The B of A data shows on their side anyways, retail buying, institutions selling. So that's kind of the flow of funds thing. But so the president said, I don't want to rag on Trump too much, but I just, everything needs to be fact checked. So I just want to be factual about what's going on. Okay. So he was on CNBC yesterday and he made a lot of statements saying everybody thinks tariffs are bullish and et cetera, et cetera. Okay. So what are tariffs? Tariffs are a tax, and they are paid by corporations to the government. They're collected by corporations and they are paid to the government. Okay, so let's just put this in perspective. In the last fiscal year, corporate taxes paid to the US government were down 7%, from 393 billion to 366 billion, a drop of 27 billion. Okay, so that's the last fiscal year. So even while the economy is supposedly booming, corporate taxes to the government were down. What's that about? So maybe it's not as great as it looked, as the so-called, facts that earnings are great. So the taxes actually paid to the government were down 7%. Okay, running at a 308 billion annual rate. No, I'm sorry, 366 billion annual rate. Tariffs in the latest 3 months, 77 billion. So that's a $308 billion annual rate. So it's almost as high as taxes paid to the government were at an annual rate by corporations in the last fiscal year. So essentially, the way I look at this is it's a tax increase. So the big, beautiful bill, blah, 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 everything's great, tax is low. However, this is just another tax. And it's almost like a doubling of the corporate tax rate. So the money has to come from somewhere. And in the press clips, my favorite press clip from this week's report is from Warren Buffett. So the article is Berkshire Hathaway issues stern warning over Trump's tariffs as profits impacted. Berkshire wrote in its Q2 earnings report, tariffs are an act of war to some degree. Over time, they are a tax on goods. I mean, the tooth fairy doesn't pay them. So that's Warren Buffett. Somebody's paying the taxes, and Trump is claiming that the foreigners are paying, the foreign countries are paying, but no, corporations are paying them. And how, of course, it gets distributed somehow. It comes out of their earnings, or they raise prices, or something. Their earnings go down. Some combination of all that stuff, which remains to be seen. And Powell's been talking about that in his press release. But basically, the thing to remember here is tariffs are contractionary for the U.S. economy and for corporate profits. And that basically it's almost a doubling in the corporate profit amount, the gross amount that they're paying to the government. Now, I don't see that reflected. I mean, some people you see it here and there, but that's not really reflected in the mentality of investors. That they don't realize there's been this huge tax increase. Okay, so anyways, keep that in the back of your mind. the latest economic data. Okay, so they revised the employment report and they revised it down by 258,000 jobs in the last 2 months. And of course, Trump blew his top and said it's all political. Da, da, da. So, I've been critical of the Bureau of Labor Statistics forever. They've been doing this before. So I don't want to get into the politics of it, but it's just the fundamentals of it are that the economy is not as strong as they said it was. So that ought to make you think if the employment report wasn't real, I mean, it was massively unreal. What else are they producing that's not real? Like the inflation report, the GDP report. So let's go to GDP. So, Wall Street Journal, July 30th, the weirdest GDP report. The economy grew 3%, but only because imports fell 30%. That's the title of their article is the weirdest GDP report ever. So that's not really reflected in market psychology. So the economy, they say, Trump says the economy is strong, and everybody says GDP is so strong, so strong. But the way they calculate it, so imports, add to a decline in imports adds to GDP growth. So that's just the weird way they calculate it. So a decline in imports of 30% is not a symptom of a strong economy. So basically, tariffs are up. It's more expensive to buy stuff. They front ran, before the tariffs. There were big orders for retailers and stuff to try to beat the tariffs. So that's over. And now, in the latest tariffs, of course, today, India, Trump sticks another 25% on India. So that's a total 50% tariff on India. And you combine that with Brazil, which, has, I forget how much, 30% or something, 25, 30%. And then China. So he's imposing the worst tariffs on the BRICS nations, which are, it seems like they're going to gang up together. So Brazil, India, and China, those are some substantial places, like with super high populations. So what are we doing here? We'll see. I think we're setting up for retaliation. So far, there's been retaliation. There's nothing but Trump threats. And if you do something, then I'm going to do something back. Da, da, da. Nobody's retaliated yet. Brazil just filed, I saw a headline, just filed something with the World Trade Organization. We'll see how that goes. But anyways, retaliation, I think, is coming. Because if you look at the 1930s, whenever you slap tariffs on somebody, they respond. And okay, then the other thing is he's claiming that that Europe and Japan are going to invest $600-500 billion each of them, blah blah blah. So the headlines on that, I'm looking on the press clips for next week's report, and so here's the headline: Trump's love affair with EU's $750 billion energy promise is built on shaky ground. So they also promised to buy $750 billion of energy. Underlying the problems with the feasibility of the EU's energy pledge is if they bought all U.S. crude, LNG, and coal exports at current prices, it would amount less to $170 billion. And they promised $750 billion. So it's unrealistic. Okay, here's another headline. Trump is hailing the EU's $600 billion investment pledge, but it might never happen. These are CNBC stories. Blah, blah, blah. So far, the only detail that is certain in the EU's pledge to invest is that the private sector will be footing the bill. There is no enforcement mechanism. Okay? So it's all kind of vaporware. It's almost like when software companies used to announce things that didn't exist. So a lot of these things, I don't want to belabor the point, but the president is announcing things for headline impact. And if you fact check the details, it's nothing like a real trade agreement. Some of these things, are they real, or you don't know? I mean, are they just basically he's just trying to jam the market up, it looks like to me, with a lot of these things. So I'm not an enemy of Trump. I don't have Trump derangement syndrome. None of that stuff. I like the fact that he won the election, et cetera. But this stuff has gotten really, really weird, and it doesn't comport with reality, and it has important investment market implications because he's trying to impact the psychology, basically to egg retail investors on about how great America is, blah blah blah. The market's so great, da 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 da. And he's fueling speculative bubble psychology. So then let's cut to the chase here. This week's report was about the AI bubble, and if you look at my main commentary page, you'll see a chart showing $100 billion in quarterly capital expenditures by Meta, Google, Microsoft, and Amazon. And basically, the Wall Street Journal reports that this percent of GDP, this capital expenditures as a percent of GDP, now exceeds the 2000 tech bubble top. And I assume most of you were around back then, but if you weren't, the Belkin report was, and things got really ugly after the March 2000 tech bubble top. And a lot of these companies just vaporized. The NASDAQ went down 83% over the next 2 years. Okay, so we have a basically exaggerated euphoria. Retail's buying it, lapping it up. They keep buying every day. They buy bag 7 stocks. However, beneath the surface, institutional investors are selling, and we have these excesses that are similar to or even greater than what happened to the tech bubble top. And so put that in perspective. So what happened? It was overinvestment. So what everybody invested in, the companies back then, it turned out to be a glut, not a shortage. So now it looks like the popular psychology thinks we don't have enough NVIDIA chips. We need more chips. Everybody wants more NVIDIA chips. Increase the orders, double order. Well, all of a sudden that turns out to be a glut, after a bubble. And then they go, oh shit, what do we do? What do we do with all these data centers that we built? What do we do with all these chip orders? And then things start getting canceled. So we had a kind of lousy report from AMD today. It hasn't hit NVIDIA yet, but I think it will. So that's kind of the fundamental backdrop of what's going on. Tax increases on corporations, and nobody's really even noticed that. So let's go to what does the model say? Okay, so model forecast, just to review what I do. I have a forecasting model based on time series analysis, developed it at UC Berkeley, then at Solomon Brothers Proprietary Trading. It's based on the mathematics behind Fourier, Box-Jenkins, the stuff that I studied back at Berkeley in the business school and in the statistics department. Learned how to apply it in an innovative way that's not in the textbooks. Came up with this original algorithm. We used that in proprietary trading in the equity group at Solomon. There were 4 of us running the house account on the equity side from about 1989 to 1992 until Solomon blew up on the bond market side and everything kind of disassembled. So what does the model do? It gives direction, position, intensity in a 12-period forecast. So I'm always looking forward. It's not like you're looking at a chart that ends today. I'm always looking forward. So direction, up, down, or neutral, position, beginning, middle, end, and intensity or confidence interval. Direction, position, intensity. So different things set up at different times. And most of the time I'm using weekly data, which is next, so 12 weeks, forecast horizons, next 12 periods, 12 weeks is 3 months. So most of the time I'm focused on 3 months. However, when the long-term forecast sets up, which is rarely, it's not, every few years or a long time in between, then that's really the most important thing. And so that's my excuse for missing this big rally. Sorry about that. The long-term forecast points down unambiguously. So S&P, NASDAQ, direction, position, intensity down huge, just like 87 top, just like 2000 top. I mean, these things don't set up that often. So the market is looking for an excuse to go down in the model forecast. And you got all these crazy excesses and the people keep buying it. They keep, trying to insane, speculative psychology, buying every little dip, buying the dip is running rampant on Google Trends. But it's so what does that tell you? It's a long-term top in the market. So, my concern is that investors do not get left holding the bag and getting hosed as they did after the 2000 top or the 2007 top. I think this is a major, major long term top, and we go into liquidation. Last week's report was about margin debt. And what happened is, so margin debt was already rolling over. And then when Trump did the U-turn and got everybody back in the market, we had 2 months, probably 3 months off. They haven't reported July yet. But so May and June, there was this huge increase back in margin debt. And margin debt is now $1 trillion. That's just the reported stuff, right? So you have no idea in these hidden structures what's going on. So basically, we're totally leveraged up on the long side, not we, but investors are. And in a deleveraging, I probably don't need to remind you how it works. The price goes down, somebody gets a margin call, they force selling, that price is down, go down more, somebody else get a margin call, and it just feeds on itself, turns into a snowball and goes on for a long time. Could be a crash, could be more like a rolling thing. I don't know. I'm not forecasting a crash, but it basically goes down big for a long time. So if, depending on who you are, like short-term trader, you can look somewhere else for, try to buy every dip and make a little 1% here and there. Long-term investors should be, like Warren Buffett. What is Warren Buffett doing? He's selling stocks. He is, look at his latest report. He's out of this thing and he's liquidating, selling into it. And as painful as that might be, like saying, if you're looking at your screen, everything's green, and you say you have FOMO, fear of missing out. Oh God, it's going up. I'm not in it. I think that is not the fear to be having right here. The fear you should be having is fear of getting crushed in the forthcoming long-term downtrend. So I can't say it any more clearly. If you're like a family office, just have minimum equity exposure. If you're a hedge fund, there's all kinds I'm going to give you a bunch of trades here in a minute. There's a bunch of stuff setting up long, short, but basically, I think you want to be absolute minimum long exposure to the overall stock market, especially NASDAQ and Europe and Asia, and basically short the market if you can handle that. Puts, just short things. I think things will fall more than other things. I'll get into that in a second. So that's the overall view. Huge bubble top, long-term forecast down, super speculative retail, like you're just crazy bullish for at the wrong time, and there's going to be a crushing event. So the market's looking for an excuse to go down. It's overlooked a bunch of them so far. I don't want to talk about the Mideast, but I follow that closely, and it's not getting any better. Israel is going back into Gaza, and then what is that going to do with Iran and the Houthis and the other strong in the Middle East, the Saudis and everything? How are they going to look on that? So that's just one thing. Then we got Taiwan. By the way, almost all of NVIDIA's high-end chips are made in Taiwan. They're building factories other places, but all the NVIDIA really high-end AI processors are made in Taiwan, and that's not reflected in the price of NVIDIA. Something could come out of I'm not forecasting a war, but I did. There was a interesting thing in the New Yorker. The New Yorker has some great articles every once in a while. Their hit rate isn't super high, but they have really well-written articles. And there was I put that in the press clips a couple weeks ago. There was a war game run in the U.S. of a blockade of Taiwan, and it escalated very quickly. And the bottom line is, it wasn't even a full-on invasion, but it turned into a shooting war. And in this war game, the U.S. lost 3 aircraft carriers out of 11 total operational carriers. So that's a third almost of and 25% of the U.S. Air Force. So is that reflected in the Taiwan stock market or NVIDIA stock? The risk of that? So the market is just looking over this stuff. It's really being stupid. You're not supposed to say the market is wrong, but on the other hand, what did we learn in business school? the market's supposed to reflect all available information. Well, I'm sorry, it's not. It's overlooking, because of this speculative bubble psychology, stuff is not being discounted. So there's this potential for something out of left field from all kinds of places. So what do you do? Okay, so my favorite trade, the model's favorite trade all year, has been long gold stocks. Okay, and I have gotten almost no positive feedback. I mean, zero on that. So either everybody's missed it, or nobody's saying anything, or I don't know what. But just to put this in perspective, if you go to the Belkin report on the stronger industry group pages, it's got left side stronger, right side weaker. Those are the longs and shorts, basically. The gold stock's been at the top of the list for almost the whole time, I think. Okay, so how's that worked? The GDX gold stock ETF is up 69% year to date. Got that? 69%. Does anybody even notice that? So gold is up 28%, physical gold, and the GDX, which is heavily weighted towards the large cap gold stocks. Okay, that's almost 9 times the increase in the S&P 500. Okay, which is up a little bit less than 8% at this point. Darn. Just ignore that. Okay, so up 69% GDX. And so for those of you that do not subscribe to the gold stock forecast, I have a report called the Belkin Gold Stock Forecast. It's a bi-weekly report, and it breaks out in greater detail gold stock index picks in the US, Canada, Europe, Australia, South Africa, and China. And the gold stock market is inefficient. There's a few Canadian brokers that follow these companies, but compared to like tech stocks that have 9 analysts following every tech stock, it's much more inefficient. And the point is, that's good for stock picking, because it means there's a lot of hidden gems there. So I'll just say, the model likes to buy low and sell high. That's basically what it does. And that could be in relative terms. So it's always looking for, in sector rotation, things that are going in and out of favor within sectors and groups, and then stocks within those groups if you want to be short, the stocks that want to underperform the most, short them, or the stocks that want to outperform in the outperform groups. So anyways, here's what's happened. There have basically been outflows from GDX all year, maybe until recently a little bit as it started to come in. I haven't seen the latest figures, but basically through the first 6 months or so, there were hardly any inflows. So the GDX was up like 60-something% on selling. Hello? What's that about? How could something be up that much and nobody's in it? And they're selling every little. So it's the opposite of the stock market. It's the antithesis, right? So that people are buying the stock, every little the Nasdaq, right? Got to buy it, got to buy Meg 7, and yeah, it's up a little bit in the year. It's not a massively up year yet, and it's probably going to be a down year by the time we get over this. That's the forecast. But so what changed? All of a sudden, in the last couple of weeks, the people started noticing something in the gold space, and let me tell you what it is. So Pneumont came out with great earnings last week, I think it was. So there's something called all-in sustaining costs, AISC, and I've tried to explain this to people, and some of my clients even have never even heard of this. I don't understand. Like, this is how you value gold stocks. People don't even look at this. So it's unknown, unfollowed part of the market. AISC, all-in sustaining costs. So basically, that's everything, if you're a gold miner, that it costs to produce an ounce of gold. So Pneumont came out with AISCs, all-in sustaining costs, of $15.93 an ounce of gold. Okay, So the current gold price is around 33.80 last time I looked. So that's $1,787 an ounce of profit if they're producing it at 1593. So 33.80 minus 1593 is 1787. That's 112% profit per ounce for Newmont. Newmont's the biggest cap gold miner. It kind of goes back and forth because other ones have surged. And the Newmont stock has been really depressed. All right. So it's just started to move in the last week or so. Um, so Newmont, let's go dig a little bit deeper there. Newmont has a forward PE ratio of 9. That's NINE. The S&P forward PE ratio on BS earnings of forecast earnings, which aren't going to happen, is 23. So do you get the picture? 9 PE of Newmont. Okay. So they forecast for S&P earnings growth is 10%. That's what's built into the market. I maintain it's not going to happen. The price earnings growth rate for Newmont is 64% forward looking. Okay. So basically, you put that together and you come up with a price earnings growth ratio, which any stock picker is familiar with using that. So for Newmont, that's 0.8 versus 2.3 for the S&P index. So anything below 1 is considered cheap. So long story short, gold stocks are cheap. That's just one example. Barrick is another one. And these stocks were not leading the market. So Barrick, symbol B, Newmont, symbol NEM. These are the biggest cap U.S. listed gold stocks, although Kinross and Agnico have sort of crept up because they've moved more. But so all of a sudden, in the last couple weeks, these stocks as a group have started to really take off. All right. So it's like the market consensus, which has completely missed this rally with the GDX up 69%, is all of a sudden starting to buy these things. So it's a thing all of a sudden. Gold, and let's just talk about gold for a second. So gold up 28% year to date. Central banks are buying gold. Okay. The gold reserves of central banks, they are rotating out of dollars and rotating into gold, among other things, but gold particularly. Gold is the second largest reserve asset for central banks now. Okay. And it's just, to me, it's like, to them, it's another currency. Of course, it doesn't have default risk. It's not paper. They can put it away. So China keeps accumulating gold. So basically, there's a bid under the gold price. That's the point. The gold price is probably not going to go down very much because central banks are dip buyers. So it's supported. The gold price is supported. The gold stocks are super cheap, even though it's up 69%. GDX, there's a lot of gold stocks. If you look at the gold stock report, or even in the Belkin stock, in the Belkin report, on the Outperform Ideas page, there's a lot of individual gold and silver stocks that haven't moved that much yet. So there's a great buy low opportunity in relative terms for a bunch of names. I still like silver. Gold, silver usually outperforms gold in a big gold rally. It's starting to happen. It's pulled back a little bit. Silver got trashed last week when Trump reduced the tariffs on physical copper. Some of the metals got killed. They're coming back now. So that was kind of a fake out, I think, and a buying opportunity. So long story short, if you want to be long something, the model's best idea, as it's been all year, is so long-term forecast. I go XAU divided by S&P, XAU index divided by S&P, direction up, intensity strong, position early, still after all this. So it's a long-term signal. I think it's going to last. If you want to be in anything in a bear market, that's like the number one thing. Okay, enough said. Okay, the dollar. Let's talk about that. So the dollar's been a great short. Long-term forecast is down, but all of a sudden, a couple of weeks ago, the intermediate term forecast changed. So it's always a dilemma when I have a conflict in signals between intermediate and long term. So I'm going with the intermediate term. I covered the dollar shorts. The dollar was a great short, for months and months. That was a top Belkin report position. Worked great. Uh, Now I'm long the dollar for a tactical bounce, and that sounds a little bit contrarian because it sort of contradicts what I just said about the gold. You think, oh, the dollar's going to go up, bad for gold? Not necessarily. Not in a risk-off environment. And what is the dollar up forecast up the most against? EM currencies. Okay, so if you go to the Belkin report on the portfolio page that says at the top, model macro global positions, um, you will see things like these are fresh positions: long US dollar versus Brazilian real, Mexican peso, Chilean peso, Taiwan dollar, Malaysian ringgit, Korean won, Thai baht, Philippine peso, India rupee, Russian ruble, Colombian peso, South African rand, Peru sol, and brand new this week, Chinese yuan. Now that's a big one. So all of a sudden, sell signal on like devaluation Chinese yuan, and it kind of fits into what's going on. We had this incredible rally in the Taiwanese dollar, of all things, about a month or two ago. That's over. So I think you short the Taiwan dollar, short the Chinese yen. So what? Like, who cares? I'll tell you what. It's a huge, major risk-off signal. What's been happening for the last forever? Got to buy emerging markets. Emerging markets are a place to be. You got to buy. All these inflows into emerging markets. And some of these, if you look at EM and frontier markets, they're like crazy in the stratosphere, like markets crazy things like blind money has been pouring into places like Tunisia, Senegal, Romania. I mean, WTF, what is going on? This is crazy. So there's been this huge inflow into these, and that has now peaked as far as I'm concerned. And what happens this is a symptom of a risk off move in global markets. Okay. EM currencies start to weaken, EM bonds start to weaken. So basically, if you've been around a long time, you've seen this scenario over and over. The capital in the up phase of emerging markets, they get capital inflows, their currencies strengthen, their interest rates go down, their equity markets rally. Then all of a sudden, when it reverses, people get nervous. They pull the plug. They start dumping illiquid markets. And believe me, if you try to sell Slovenia, which is like one of the most advanced markets out there at the moment, Slovenia, Estonia, how did those double? This is like nuts, completely crazy. But anyways, Brazil, what happens is it works in reverse. So capital outflows, currency weakens, interest rates go up, stock market goes down, everything goes from rosy to ugly. And it's not necessarily instantaneous, but it's a process. So that's a new signal in the last few weeks. Changed on the dollar, tactically long, particularly versus EM, which is a major global risk off signal. So risk off, sell emerging markets, sell their currencies, even their bonds. Okay, what else changed? New position this week. I've been short. The model has been short treasuries and Canadian, a few other places, similar Canadian bonds, things like that, for quite a while. It's worked well. So if you look at, say, the TLT is the T-bond, 30-year T-bond ETF. It's down 13% in a year. So a year ago, it was, 102? I'm going off the top of my head here. It peaked out September 16th, 2024, which is 11 months ago, right? And of course, there were lots of reasons for bonds to decline. Government spending out of control, deficit blowing out, dollar going down, and the model was on that, worked. Short bonds was the place to be. Position closed out this week, over. Model changed, intermediate term forecast up. So we just switched from short bonds to long bonds. And let's talk about that for a second. So my old acquaintance Scott Bessent, now Treasury Secretary. If you're listening out there, Scott, hello. I'm not in touch with him anymore. I don't claim to be, influencing his thinking or anything, of course. I'm just watching from a distance. But he says he wants the 10-year interest rate to decline because that will be stimulative for the U.S. economy. Okay, Scott, I think you're going to get your wish, but be careful what you wish for because interest rates decline in recessions. And if we go back to the original scenario of this huge corporate tax increase, almost doubling from the tariffs, and all of a sudden companies like warning profits left and right, if you look at the press clips, we are in for a recession, okay, at least. We're easing into it and nobody's looking for it anymore. Low recession probability, 20, 30%. Whereas 6 months ago, everybody's predicting recession. Now nobody is. Even Mike Wilson, Morgan Stanley, he redeemed himself. He almost got fired, probably for being too bearish. Now he's the Uber bull. It says buy every dip and the economy's great and it's going to be all this investment in the U.S. The Belkin report says no. Belkin model says bonds are going to rally. So is that going to be bullish for the stock market then? Interest rates fall. Oh boy, the Fed's going to cut rates. Then I get to buy stocks. Oh boy, the bubble's going to get bigger. Okay, so why? The TLT S&P ratio, direction up, intensity strong, position just starting. So if you are listening to this and you are a sovereign wealth fund or a private family office or a pension fund or an insurance company or any of those big institutions that some of our clients are, very simple time. Here's a little recommendation for you: sell all your stocks and buy treasuries right here. And when that works great in bear markets. Okay, so treasuries. Why would treasuries rally? The deficit's so bad, government spending. Yeah, but if the market gets scared and we go into a stock bear market, then there's going to be this outflow from equities into bonds, treasuries, and that's what the model says to do right here, right now. So sell stocks, close your S&P long position if you're in the market. You've done great. It's way up here at the high. Bonds are at a low. They're down 13% in the last year, TLT. And so that also includes three other things: TLT, LQD, MBB, and IEF. So liquid, corporates, MBB, mortgages, and IEF is intermediate term, 10-year. So TLT is 30-year. So basically, high-grade corporates or investment-grade corporates, that's LQD, not junk. This does not include junk or Latin American debt or anything like that. So just high-grade corporates, mortgages, yeah. Intermediate-term treasuries, yeah. But the juice is probably in the long end, even though the yield curve still wants to steepen, which suggests that the Fed will be cutting rates at some point, and the 2-year will drop more than the 30-year. But the actual price action will be greater in the longer end. So big change. Belkin report's not a broken record. It's not a broken clock. It changes, and this is one of those changes where been short, time to go long treasuries and close all your stocks. Okay, let's dig a little bit deeper beneath the surface. What else is going on? VIX up all of a sudden. So we had this big rally last week in the VIX. It was up 20-something%, pulled back last few days. And so the VIX is how people carpet bomb. They carpet bomb the VIX, and it makes the market go up. So basically, sell volatility, stocks go up. That's worked like a charm for bubble people, basically big institutions, and guys that hedge portfolios. So I think there's going to be a squeeze in volatility. So long VIX, early days, looks like it wants to go up big time. What other kind of, so here I am forecasting long-term top in the market. Stocks want to go down, bonds want to rally, emerging markets want to liquidate, currencies, capital flows out. This is basically a global risk-off scenario. What else contributes to that? Okay, let's look at financials. So nobody is. I have not seen anybody at all pick up on this. So in this week's report, I've been putting it in there for a few weeks. There's a ratio chart towards the bottom chart, left hand side on the first chart page after the commentary page. Financial sector divided by S&P 500 ratio 1 year. This thing peaked out XLF. That's XLF divided by SPY. If you want to do it on your screen, it's minus 8% since April 22nd. 4 months. Hello. Has anybody noticed? The financials have 8% negative alpha. What the heck is going on? So I've had banks on my cell. The Belkin report has had on the underperform list regional banks, brokers, which haven't worked yet, money center banks, things like auto finance companies and asset managers. So those overall, the financial sector is underperforming massively. It's almost double-digit percent underperformance. So what does that tell you? I mean, hello, something is going on beneath the surface. Like, why would financials underperform? Somebody is dumping financials, okay? And that's does that ring a bell? Like 2007, remember late like October through December when the banks started going down, the market kept going up for a little while and then rolled over big time. So just look, the model's still short financials, it underperformed signal. And what are the implications? Everybody ought to be thinking about this. Why are financials underperforming? Are there depth charges hidden? So all of a sudden, you've got default rates climbing on subprime auto loans, credit card low credit quality declining, non-performing loans starting to go up just early, just the tip of the iceberg on that. Okay, so but that's something I have not seen anywhere else. So hello, look out for financials and think about the implications for that. Okay, let's look at Europe. Okay, in this week's report, okay, remember what's been the major theme? Not our theme, but the theme out there is gotta buy Europe. Europe is so cheap. Europe is great. I gotta buy Europe. Yeah. Let's go like Europe. So all these inflows went into these European cyclical companies. Germany is like one big industrial manufacturing, car manufacturing place. And but if you look at the DAX, that's the third chart down on the right-hand column on the chart page after the commentary page, this week's report. What did it do? It peaked out, maybe a month or so ago. It hasn't really hit a significant new high since looks like April-ish. So what's that? May, June, July, August, 3-4 months. So all this money went in at the top, and it didn't really keep going up. And now it's rolled over. And so you've got these big European cyclical companies, which are on the sell list. I'll go over that in a second. But so sell Europe. That is a. You hear? Is anybody else saying that? So the Belkin report says short Europe, close your Europe long positions. DAX, CAC, FTSE, Spain in particular, and Italy. They're up there in the stratosphere for no reason. So I think European major top and European markets really been underperforming lately, particularly the DAX, rolling over big time. Great shorting opportunity. And if you dig beneath the surface in the Belkin report, stocks, Euros, there's a page called Stronger and Weaker Euro Stocks Sector Prospects. Longs on the left, outperform on the left. Shorts, underperform on the right. And what do you get? So the model, this is what the model says to do in sector rotation in Europe. Top 5 names: sell Ericsson, Nokia, ASML, STM, Bezi, Infineon, Adyen, SAP. The biggest cap tech stocks in Europe. Short them. Okay? Can't be any more clear than that. There's a bunch of other intermediate, medium-sized names after that. Next group down, industrial goods and services. The things, there's just a whole bunch of names there. Siemens, Maersk, You can look at the list yourself if you don't. Financial services, LSEG, these really went parabolic. So you got London Stock Exchange, Deutsche Börse, Euronext, great shorts. They've come down some, but so that's a symptom of in the uptrend, the stock indexes outperform. In the downtrend, they get dumped. So financials in Europe also underperforming. And then construction and materials, insurance, things like that. Retail. So it's basically cyclicals look terrible in Europe. Retail, Currys, Inditex, Next, things like that. Shorts. And banks, which haven't topped out yet, very frustrating. The signal's still there. It's been very frustrating, but they've held up much better than I thought. That one hasn't worked yet, but they're at the still at the bottom of the list. So what do you buy in Europe if you want to outperform? That's the left-hand side. Utilities. Boring, right? Telecom, Telenor, Vodafone, BT, boring. Oil and gas. Who wants that? It's yesterday's technology. We're going on. We want new energy. No. BP, Shell, ENI, basic resources. Some of these are depressed. So things like Rio Tinto, these are outperform ideas if you're doing a long short book. And then personal and household goods, food and beverages. So I've had Campari, which had a huge move. So here's an example of the model. It likes to buy low. It bought all these Campari, Diageo. Those stocks have had big moves, but they're coming off a low. So there are rotation things happening. And so let's talk about rotation in the U.S. That's Europe. So I'm kind of trying to reinforce this global risk off major long-term top theme. So I already told you gold mining, best long idea remains. Let's not spend any more time on that. Let's talk about energy again in the U.S. So again, I'm on the other side of Trump on this. He wants to have low energy prices and Scott Besson and everything. Let's get the energy price down, good for the economy, and OPEC's increased production. Looks terrible for oil, right? I don't know. The model still likes the stuff. So they're very, very depressed. Nobody likes them, kind of like gold stocks were at the bottom. So big stocks like Chevron, Exxon, Mobil, energy service stocks really beat up. They've been acting better, not today, but recently. Energy MLPs. Now, here's a great long idea for you. Energy multi-limited partnerships, right? These are like pipelines. There's a ETF AMLP. It's in the Belkin report. 8% dividend yield. Now, this thing's not very volatile. It's not very liquid, but 8% dividend yield. Hello. If you're looking for something that wants to buck the trend with a potential capital gain in a down market and with a huge dividend protection to the downside, AMLP is an ETF. After that, it's utilities. And of course, utilities have a AI exposure, right? Like who's going to make all the juice for these, for these data centers that are still getting finished. So there's a double whammy there. Even though I don't like data centers, the utilities will have to expand production, but they're defensive, high yielding groups, right? So a bunch of utility stocks, and then these really boring beverages stocks, so what happened? TAP, Molson Coors, Molson, whatever it's called, they came out with supposedly lousy earnings. The stock went up. So those are stocks that are on the outperform list. And here's one for you: home builders. These have been shorts. There was a great short, underperformed massively for a long time. Model just flipped around on home builders. And that kind of fits into the change on interest rates. So if the bonds turn around and mortgage rates come down a little bit from 7%-ish down, then all of a sudden people say, oh, maybe home building will come back. So home builders could bounce. Still like aerospace and defense, obviously, they're gonna be having huge orders there. These are things that have been on for a while, and that's pretty much it. No overwhelming long ideas other than gold mining. So gold mining is still it's the place to be, and so that would be stocks like Pneumont, Barrick, symbol B, Hecla, symbol HL. And then the South Africans just turned around. That's Gold Fields. And some of these other ones have moved a lot. Agnico Eagle, AEM. The silver mining stocks are still pretty depressed. That would be Pan American Silver, PAAS, things like that. And Equinox is an interesting company. I have a buy low list in the last gold stock report, which I just did yesterday. So here's some stocks that have been knocked down recently in the gold, silver, platinum space. Ivanhoe, IVN.TO, Canada, got knocked down, had a mine problem. It's a good entry point, buy low. Equinox, EQX, great gold company. Alamos Gold, AGI, Franco Nevada, kind of has been a dog, starting to turn around. And B2 Gold, a symbol BTG. That's an interesting one. Million ounce producer. My sources tell me that the leader chairman is a jerk. Nobody likes talking to him, so it's an unpopular company. And they do have some exposure in Mali and places like that, which is problematic. But it's a million ounce producer, and the stock is in the doldrums. It hasn't moved at all. So Templeton said time to buy is point of maximum pessimism. Time to sell is at the point of maximum optimism. And let me see. Anything else? Okay, a couple other things, and then we'll wrap it up. Cyclicals look terrible. Defensive looks good. So if you're running a matched book, say you're a hedge fund, some of our clients, of course, hedge funds, and you want to be market neutral, I think there's some interesting long short ideas where you could be long GDX, short XLK, things like that. That's gold stocks versus tech, or long utilities versus short financials. So that's XLU long, short XLF. That's a market neutral position. You don't care what the market does. You just care what the difference between those things is. So defensives want to outperform, cyclicals and tech want to underperform. Mag 7 totally hugely overowned, overbuilt, everything. We look ahead for a glut that's going to cause, saying people to say, oh crap, it's not, we don't have a shortage anymore. We have a glut. And Trump says talking about tariffs on semiconductors. That's preview of coming attractions next few days. Let's see how that turns out. Okay, then a couple last things. Bitcoin. So the model came up with a great call. I hope you followed it, got it back on Ethereum at the low. This is about maybe 3-4 months ago. Ethereum was in that symbol ETH. It was in the gutter, and Bitcoin was so the model went long Bitcoin and Ethereum way back then. If Ethereum's more than double, I think. We stood aside. We just put a short out on Bitcoin. Okay, and so Bitcoin's and that has an implication for Bitcoin stocks. Now these things are not very liquid, but there's an ETF WGMI. Bitcoin mining stocks, and these are basically fly-by-night companies. That aren't. Bitcoin price goes down, they're super leveraged to it, and they're not going to be making so much money on their Bitcoin mining. So looks like Bitcoin is not like gold, right? Where gold is going to be contra a bear market. I don't think so. I think Bitcoin is just another overrun speculative asset. So short Bitcoin, fresh position. Short Bitcoin mining stocks, fresh position. Things like ARK, ARKK, up 31% year to date. What's that about? This is crazy. So I think there are opportunities for shorts out there if you're a short seller, and they're not the kind of shorts that you would spring to mind, like saying stocks that are down a lot. So, some of them are. So, like EV on our sell list, there's EV stocks. A lot of these are going to zero, right? They're just not going to make it. These stocks are not going to be around. They'll get bought out. Lucid might become part of Ford or something, but then not for the price of the stock. Probably they'll probably I'm not picking on that particular company, but there's a whole bunch of EVs. But those stocks are down. These other stocks are up. So they're up. There's a lot of crappy stocks that are up. Software companies up in the stratosphere. And if you look, so the software sector divided by S&P looks strong, but beneath the surface, that's because of Microsoft, largest cap stock. There's a bunch of software stocks that are being liquidated. They've had a little bounce, but they look like they're in trouble. So software is a short, social media is a short, internet stocks like Chewy, you know, I mean, these are kind of you know, Carvana that had a huge bounce. These are looking like toppy stocks you want to short. You don't want to be in them. Cybersecurity stocks, shorts. Like these are popular stocks for people. Hotel stocks, shorts, Marriott. Securities broker stocks, shorts. Interactive media, Google, short. Communication equipment, short. Nokia, Ericsson. Specialty retailers, shorts. Gap, GME, uh, emerging market banks, shorts, money center banks, shorts, regional banks, shorts, credit cards, shorts, asset managers. I don't want to laugh, but I mean, this is what the model doesn't like come up with this stuff out of nowhere. This is what the model is saying. Retailers are short. What does that tell you? The economy's going down. Autos, shorts. Teslas are short. Auto components, shorts. US listed China stocks, shorts. Da 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 da. Goes on and on. Road and rail, shorts. Airline, shorts. Construction engineering, that's a brand new. Of course, these have had a big boost from the AI data center build out. Shorts, brand new this week. Building products. So a lot of this stuff looks like it's rolling over. Just to sum it up, you've heard it all here. It's gone on for quite a while now. Overall view: tariffs are a tax. It's almost a doubling of the corporate tax rate, as it turns out. Of course, it remains to be seen how that gets distributed by the corporations to their profits or to higher prices or whatever to the people that they buy from. Long-term forecast down, model forecast like 2007 or 2000, tech bubble top. Bonds all of a sudden which were short are a buy, risk off signal, sell stocks, buy bonds. Emerging markets rolling over, emerging market currencies all of a sudden weaker after being a strong signal for a while. Now all of a sudden you want to be selling emerging markets, emerging market capital outflows. If you can figure out a way to short frontier markets and emerging markets, this is a great entry point. Oh, I forgot to mention restaurants. Restaurants have been a great short. Again, a symbol of the U.S. consumer, weak consumer spending. And then what else? That's pretty much it. You want to be careful out there. And my concern is you don't want to end up like people that ended up after 2007 or 2000. So, for instance, I'll just end it on this note. Sometime it was late in 2008, early 2009, I spoke at the Seattle CFA Society. I was a guest speaker. I was invited. And I said, my title was Light at the End of the Tunnel. And the model forecast was looking for I'm not always bearish, not a perma bear. I've been on the right side of that decline, 2007, 2008 credit crisis decline. There's some big swings in there, but of course, you know what happened. S&P went down more than 50%. And so I was in this room of portfolio managers in Seattle, you know, this fancy hotel. And I'm giving this positive forecast for the market's going to bottom. It's almost a huge buying opportunity. And everybody was saying, oh yeah, that's really great. Except I don't have any money left. My investors are pulling all my, I've been redeemed almost out of existence. My retail investor, the retail stockbrokers in there said, oh, well, my clients have pulled all their money. There's no way I can buy anything. That the institutional money manager said, well, I'm getting redeemed. So do you understand what I'm saying? It's like at the bottom, you want to be there with cash when the liquidation is over. You don't want to be left holding the bag saying, well, I didn't get it right on the way down. So I want you to get it right on the way down. I want you to survive and do well in a bear market, which I think we're headed into. And I think that's it right there.
Michael, thank you very much. If any of you have any questions at all, please feel free to call me at 419-554-7009 or email. You all should have my email. And any questions for Michael at all, please call us. Michael, thank you again, and good luck out there to everybody.
Thank you, Mark.